Hello there, Andrew Faldy, and we're looking at a chart of VXX, and this thing has just gotten hammered here as the market has settled out and started to drift up, and volatility, being an inverse correlation, has been moving into a downtrend. And VXX, if you're not familiar with it, is a volatility ETF, and it has a negative drift. You can see the split adjusted price going all the way back here is currently up. I don't even know if I'm looking at all the data, but I kind of think I'm not. Let's see. Yeah, that's going all the way back. So a little over 7,000 split adjusted, and is currently trading around 17, I believe. Let's get back to the front of the chart. So it just crossed into the 17 handle, and that moved from its high back in February in the upper 20s. So quite a big move here. And being that this has a negative drift in it, constant splits to adjust the price back into its target range in the teens and 20s, seeing this thing continue to get annihilated is not a big surprise at all. And you can see that it's approaching all-time lows, even as the market's not quite back to its all-time high. And even if the market were just to trade sideways in a range for a while, VXX probably will continue its negative drift and can really start to catch up even more on the downside. So this is something certainly I'm not interested in getting long, and typically always looking for a short bias and short opportunities in VXX, and also a related instrument, VXX, which is actually what I take positions in. But the VXX, something I look at and do a lot of studies on. And so recently I've been studying best ways to get short, using systems, using signals, and trying to optimize something. So first I tried momentum-based signals. They seem to work, but they're a little bit lagging, lower probability, take a lot of whipsaws. So instead I looked for rallies and fading rallies to get short. So I wrote up this code here, simply called it fade. Not a very creative name, but that's what I called it. And so this fade script is actually intended to optimize several different ways to fade the market. So I just wrote them all in at once, and I use these things to say, if the trigger type is 1, then do this. If the trigger type is 2, then do this. And then this is the mean. So we're looking at the type for the mean, linear regression, average, and exponential average. Then I calculate the upper limits, so I'm looking for overbought, oversold conditions using ATR from the mean or the regression level. And then this is just the execution algorithm for if we're, this is a condition here if I want to use a trend, which did not work very well, so I'll just collapse that. So you can see it's actually quite short when we get rid of that one. So this says if we're above the upper band and we're starting to roll over, then short this thing, and I'm just using a $100,000 position just to keep it simple for math purposes. And then it says if we get to the lower band, close it. So that's what we're looking at. I also did have this buy signal in here, but this thing's just so terrible that buying it on signals is not so great. That's probably best left to short-term traders looking for entry opportunities, but on a signal basis, not the best thing to add in there. So this is the fade, and then what I can do here is I can go in and say, do I want to use a trend or not? I'm just going to leave that off for now. Look back, so I can say what period do I want to look back for? Ooh, there was some thunder. For the mean. So I just use something simple like 10 to 30. So there's the mean. And then ATR, I can look for a really small move, so just a tenth of an ATR above the mean. That would just be a minor amount, making sure we're just putting in some good rally above the mean by a certain distance, and then because we're also going to be waiting for it to roll back over, so I got to give it some room. And then I can move that up all the way to 2, and we'll just add some increments there just to see what comes out. And then trigger type, I have linear regression, average, and exponential average. So there's just 3 of those. So I'm going to say which of those 3 works best. And the trigger look back, I want that to be very quick. So a 2-bar look back to a 10-bar look back, that'll be very quick. And then this is the mean type that we're looking at, and there are 4 of those. Let me just double check that. The mean, oh no, there's 4 triggers and 3 means. So let me go back and redo that. Alright, it would have worked anyways, we just wouldn't have had a complete result. So I can throw this in, and if I do an exhaustive test, that's 3,600 combinations of all of those different signals. But what I'm going to do is genetic test, which is going to put it simply, just basically do a scattered sampling throughout that larger number and bring back and show me what tends to work best, so where the area that works best from everything it tests. So this is going to run through it really quick. Doesn't take long at all. And it comes back with the answer for which of those 1,000 combinations tends to work best. So this is the one that came out as the optimized. It doesn't mean it's the best one to trade, but it's the one that did the best. So here's one, did pretty nice, but I can look at this optimization study, and this is what I really wanted to kind of focus in on, which is when you find something that works and you find a good edge in the market, you don't have to be very specific about how you implement it. You want to find something that no matter what nuance you apply to it, you still have the edge. If you have to drive it down to such specific rules to make it work in backtesting, then you're really just, that's what I consider to be curve fitting. When you found a specific set of results that works, and if you vary them just a little bit, it doesn't work anymore. So you can see here, out of the 1,000 combinations, it comes back, gives me a sampling of 159 of those. And what I could do is do another exhaustive test, but you can see it spits back out of that right here, 143 of the top of the 159 sampling comes back as profitable. So I have 149 different combinations that work. And then I can go through this, and we won't go into detail in this one, but I can look for what the common features are. So I can see which at the top tends to be the best result. And so the ATR multiplier, it's coming back at a higher number. So if you wait for bigger moves away from the mean, that's where you're going to find your better opportunities. That's very interesting. So you can see there's very few that are anything less. We went all the way up to 2 ATRs, and it's hovering in at that above 1.5, but not quite to 2. So that's very interesting, very common feature there. Also, I see a lot of 4s and 1s here, but I had 1, 2, 3, and 4. So all of these, very few 3s and a couple of 2s down lower. So 4 and 1. So here's another tidbit for you. I don't know if I used that word right or not, tidbit, or if it is a word. 1 and 4 for the, sorry, that's for the trigger. So this is saying linear regression. I've talked about that a lot in the past. And momentum, close minus previous close look back. So the average, waiting for the average to roll over, not really good. But linear regression, if that rolls over, or if momentum turns down, that's an indicator most platforms have. If not, you just calculate today's close minus the close X number of bars ago. And speaking of X, that's the trigger look back. So if 2, 4, the lowest numbers come back across the board here. Randomly we get an 8 thrown in there, but that was using momentum. 1 using the, oh that's, yeah, 1. So all of these, very short-term linear regression or momentum. Great information there. 2 ATRs above, and then that's the other part we have to know is what above what. So 2 ATRs above, and what comes back here, 1 and 3. And 2 shows up a little bit, but 1 and 3 are dominant in this. So let's get reminded of what those are, and that's linear regression again, or exponential average. So there is some edge for you. Some edge in the VXX market. If we are 1.5 ATRs above linear regression, which by the way, that comes actually out to be exactly what my LRC channel default settings are, if you've learned about that at all in the past. So 1.5 ATRs above linear regression, or 1.5 ATRs above exponential average. And the look back for that is, well, here is that 30 bar is what optimized. So it optimized to the slowest one. So I'll make a note of that in a second, kind of tell you what I think about that. Let's bring this back up here though. So 1.5 ATRs above linear regression or exponential average, and then waiting for linear regression or momentum on a very short trigger, 2 to 4 bars, to roll over is a decent fade signal in the market. Now it's a very infrequent, you don't get a lot of trades in there, but that's coming back with where each of these has really taken a big chunk out of the market in generating. Remember, this is a $100,000 position and not a very long back test, so pretty nice risk reward and good opportunities in there. And you see the drawdowns are much less than the total return. So again, we're just talking about edge. We're not talking about something that necessarily I would turn on and automate. I consider this to be one edge, looking for that setup, and then you go search for more edges, which is to get on the short-term time frame and either use discretionary setups or to use options to define your risk and find additional edges from the benefits of trading with options. So just wanted to share that. The last thing I did want to mention though was I noticed on this look back for the mean that it optimized, almost all of them came back pegged to 30. I did 10, 20, and 30. So anytime I see it all coming back pegged to one end, then that kind of lets me know that maybe it wants to look a little slower. So maybe a 40, 50, or even 60 for the mean. And then start looking at ATRs above that level as well. So, but we don't have time for that today. I just want to share that with you. If you have any questions about this, feel free to send me an email, or another way to get a hold of me is Friday afternoon with Merritt Black. We're going to be doing the trading conversations at SMBU again. So I look forward to seeing you there. Just head on over to smbu.com and make sure you sign up for the daily video. And that, if you get the daily video, then you will get the invitation for trading conversations on Friday. All right, thanks for watching. And let me share my email so you can send me any questions if you have. And here you go. afaldi@smbcap.com or andrew@faldicapital.com. They both come to the same exact inbox. So either one you use, I will get them at the same time and respond. So thanks a lot again, and I'll see you next time.